Activity 1, Teaching and Learning, Management in English, Unit 4, Accounting for Lease.
Topic of the presentation: 1. Definition of lease. 2. Key principles of lease. 3. Accounting for lease lessee. Side 4. Accounting for lease lessor. Side.
Definition of lease. A lease refers to a contract or part of a contract that conveys the right to use an asset, the underlying asset, for an agreed period of time in exchange for consideration. An underlying asset refers to the asset specified in a lease for which the lessor grants the right to use that asset to the lessee. For example, entity A, the lessor grants entity B, the lessee, the right to use machinery, with the machinery being the underlying asset. In addition, the Thai Civil and Commercial Code, Section 537, defines a lease as follows. A lease of property is a contract whereby one person, called the lessor, agrees to allow another person, called the lessee, to use or derive benefit from property of any kind for a limited period of time, and the lessee agrees to pay rent for such use. Furthermore, TFR 16 provides the definitions of the lessee and the lessor as follows. 1. Lessee refers to an entity that obtains the right to use the underlying asset, leased asset, for a period of time in exchange for consideration. 2. Lessor refers to an entity that grants the right to control the use of the underlying asset, leased asset, for a period of time in exchange for consideration.
Key principles of leases. The key principles of lease contracts include the identification of a lease, separating and combining lease components, the lease term, terms and conditions in the lease contract, benefits received from the lease, and the major accounting characteristics of lease contracts as follows. TFRS 16, a lease if it grants the right to control an identified asset for a specific period, which can be measured by time or usage, in exchange for consideration. Key principles. Initial assessment. This must be performed at the commencement date of the contract. Criteria. There must be an identified asset and the right to control its use. Reassessment. The lease status is only reevaluated if the terms and conditions of the contract change. Guidance for identifying a lease. To determine if a contract contains a lease, the customer must have the right to control the use of an identified asset throughout the period of use. This is met if the customer has both. 1. Economic benefits. The right to obtain substantially all economic benefits from using the asset. 2. Direction of use. The right to decide how and for what purpose the asset is used. Key application rules. Partial terms. If control exists for only a portion of the contract term, it is a lease for that specific part. Joint arrangements. If a contract is entered into by a joint arrangement, the arrangement itself is considered the customer. Separation. Each lease component within a contract must be assessed separately.
Accounting for leases lessee side. Lessees must follow a single accounting model, requiring the recognition of both an asset and a liability at the start of the lease. 1. Recognition. On the commencement date, the lessee records a right of use, ROU asset, and a lease liability. 2. Initial measurement. The ROU asset is initially measured at cost, which is calculated by discounting the future lease payments. 3. Discount rate. If the interest rate implicit in the lease is not available, the lessee uses its incremental borrowing rate. This is the interest rate the lessee would pay to borrow a similar amount over a similar term with similar security in a comparable economic environment, e.g. a bank loan rate. Commencement date. This is the specific date when the lessor provides the asset for the lessee's use. All accounting treatments and periods are measured from this point. Remeasurement of lease liabilities. After the commencement date, the lease liability must be updated or adjusted if certain events, like changes in lease payments or terms, occur. Lease modifications. These are changes to the scope, e.g., adding, removing leased space, or consideration, e.g., price changes that were not included in the original contract. 1. Financial statement presentation. Balance sheet, right of use, ROU. Assets and lease liabilities can be shown as separate line items or grouped with similar items with details in the notes. Profit or loss. Lease costs are split into depreciation of the ROU asset and interest expense on the lease liability. Cash flow. Principal repayments are classified as financing activities. 2. Sale and leaseback transactions. If it qualifies as a sale, TFRS 15, The lessee recognizes a gain-loss only on the no portion of rights transferred to the buyer and records an ROU asset for the portion retained. If it does not qualify as a sale, the transaction is treated as a financing arrangement, a loan. The asset is not removed from the books, and no sale is recognized.
Accounting for leases lessor side. 1. Lease classification. Lessors must categorize every lease into one of two types. Finance lease transfers substantially all risks and rewards of ownership. Operating lease does not transfer substantially all risks and rewards. 2. Finance lease accounting. Initial measurement. The lessor recognizes a net investment in the lease. For subleases, the implied interest rate of the lease must be used for measurement. Manufacturer or distributor lessors, at commencement, they must recognize revenue based on the fair value of the asset, cost of sales based on the cost of the asset, selling profit, loss, the difference between revenue and cost of sales.
1. Subsequent measurement. Finance lease. The lessor recognizes finance income over the lease term to reflect a constant periodic rate of return. Assets under finance leases may be classified as assets held for sale if they meet specific criteria. 2. Lease modifications. Finance lease. A modification is treated as a separate contract only if scope increases by adding the right to use one or more underlying assets. Price increases. The consideration increases by an amount equivalent to the standalone price for the additional scope. 3. Presentation. Lessors must present assets held under finance leases in the statement of financial position as a receivable at an amount equal to the net investment in the lease. Lester's accounting entries in the General Journal. 1. On the date the lease commences. 2. On the date the lease payment is received and adjustments for deferred interest income are made. 3. The entry in 2.2. On the date the lease payment is received. 4. On the date the lease expires. December 31st. 25/8. Presentation of entries in financial statements. 1. Statement of financial position. 2. Statement of comprehensive income.
Summary. Core concepts the chapter defines. Leases, lessees, and lessors, while outlining key principles such as lease identification, contract combination, separation, lease terms, and the economic benefits derived from leases. Lessee accounting focuses on the single accounting model, including initial recognition, measurement, remeasurement of lease liabilities, lease modifications, financial statement presentation, and sale and leaseback transactions. Lessor accounting details the classification of leases into two categories: finance leases and operating leases. Finance lease specifics distinguishes between lessors who are not manufacturers, distributors, and those who are manufacturer, dealer lessors, along with the accounting for operating leases and sale and leaseback transactions. From the lessor's perspective,